Well, let's connect with Dinshaw Irani. Dinshaw, good morning. Thank you for joining us. Dinshaw, what's your market view? I mean, we can endlessly argue about market should go down, but the fact that they're staying on, what does that indicate?
Very good morning, Nikunj, to you, your viewers, and your team. And thank you for having me on your show. So basically, Nikunj, I mean, look at what the earnings are doing, right? I mean, if you look from March quarter onwards, there's been a roughly around a 5% cut in earnings on the Nifty or the indices as such, roughly 5% across both the broader indices and the narrow indices. And what has the market done? It's gone up 11%. Even this quarter, I think roughly around 28 odd companies have reported in Nifty, and the earnings growth is 3%. If you take away, say, the financials, it's a negative earnings growth, margin compression, everything. I mean, look at the broader indices also, BSE 500. I think around 180 odd companies have reported again earnings growth of 2-3%. If you take away financials, again a negative growth. So the fundamentals don't seem to be supporting this kind of a rally. But the fact is that there's so much of flows coming in the market. I mean, and by the way, there are two legs of flows. The FII flows are negative right now. It's the domestics which are supporting. So I don't know how long this will continue. We on our part have been trying to be a bit cautious here. We raised some cash going into the budget. Still, there's some cash left with us. Not too much comforting, but still, I mean, we also try to play this out as the things progresses and probably be ready when the fall comes as such.
Dinshaw, hi, morning. So curious to know what's the shopping list looking like, or is it more of the same and just going to add positions?
So Aisha, we've not been very, I think, adventurous in this shopping list now. We're being fairly cautious. We've moved away from mid-caps to a larger extent because we believe that the mid-caps are fairly overpriced. I mean, there are 150 odd stocks absorbing so much of money coming into the flows of domestic, the DIIs rather. So we are very cautious there. We are okay with the large caps, given that they're still at a P of some 21 odd forward earnings, which is fairly reasonable given the kind of growth that you're seeing in the large caps. In the small cap space, we're again being cautious, but probably being where we are, we haven't picked up any new names in that particular area. So more or less, more of the same, I suppose.
Why are banks not performing? There has to be a reason why markets are ignoring it for so long.
Yeah, so basically, I think so. The results haven't been that great, anyways. I mean, there've been pockets of good results, and there've been pockets of steady numbers as such. So there have not been negatives, by the way. The fact is that the kind of liquidity crunch that the RBI is, I mean, sucking out of liquidity that RBI is doing from the system is making raising of deposits much more tougher. And frankly, I mean, if that is the case, obviously that's your fuel for the business as such. And that's why you don't see much of advances growth also happening. And if they do, nobody wants to be aggressive at this point in time. So I think that's why the call on this is that probably a quarter or two of again waiting out, and probably from there on onwards, because anyway, financials, I think banks per se should kick in at some point in time. Financials are doing too well, by the way. I mean, if you keep the banks away and look at the financial services, the other financial services, I think they've done phenomenally well. I mean, look at the growth, the numbers that have come out from there also. That's been pretty exciting. So I think it's a matter of time before the banks also kick in a big way.
If earnings are poor, which is what you flagged off and which is what the reality is, markets are growing higher than the earnings. They say markets should always grow in line with earnings. Sometimes earnings grow, then markets catch up. Sometimes markets grow, earnings catch up. Right now, markets are growing, doesn't matter whether earnings are. How long will this continue?
So Nikunj, the valuations can be unreasonable for a very long period of time, right? It needs a negative trigger, and that could come anyways. I mean, in some form or the other, right? The last time it came when the regulator showed concern in the small cap space, and there was a massive trigger in the small cap area. Didn't recover much after that. I mean, there were some pockets of recovery, but I think again, one can see there's some regulatory action happening. And by the way, one big negative was obviously the budget which came out, in the sense the capital gains tax. I think that was very well taken in the stride by the markets, but I don't think the FIs took that in their stride, and that's why that massive selling that you're seeing on a daily basis by FIs as such. So I think these are the kind of triggers that the market will await for some semblance to come back into this.
Okay.
Indeed. Dinshaw, having said that, just wondering, what is it that you're making of the texture of earnings so far? I'm going to keep banks outside of that. We just discussed that already. Anything that's positively surprised so far?
So basically, I think the utilities did very well. Autos also did very well, by the way, but we are not too keen on autos right now. So I think these are the various pockets, but commodities were totally a disaster as such. Staples were okay. I mean, they weren't doing too well. I mean, Colgate came out with excellent numbers though. But so that way there have been pockets of good numbers, but there have been obviously disappointments are far larger than the numbers which came out. IT came out with numbers, and frankly, I mean, I think the read was that it didn't worsen, right? And that's why IT got propped up as such. And frankly, I mean, from the results date onwards, these stocks haven't gone much further anyways. So it's more of a relief rally that happened initially, and then after that, it's been steady place. So as I said, Aisha, I don't think the fundamentals on a broader market also are supporting the rally today in the markets. However, we're being cautious, I think, more than anything else.
How do you see what could be the next news flow or next event for the market? Could it be Q2 earnings? Could it be US election? What is that one thing which we should now look forward to?
So one big event for the markets to turn positive. By the way, I don't see any major positives going into the next couple of quarters anyways. But I think the one big positive that one can look forward to is obviously the interest rate cuts. Already you can see some kind of softening in the US as such in terms of the economy and in terms of the employment and stuff like that. So I think the Fed will be tempted to cut rates, but I think they'll probably wait it out. Because anyway, if and given that all possibility point towards a Trump era coming back, the sound bites coming from there, I mean, from the Trump camp is obviously very inflationary. I mean, they're talking about putting across the board a 10% tariff on all imports into US. That's inflationary, and obviously China will be penalized. Which is a major import partner for US. Obviously, that will be inflationary again. Then they're talking about throwing out the immigrants. Again, your labor pool is getting shrunk, so service inflation will move up. And obviously, when he's talking about tax cuts, he's talking about consumption moving up in a big way because of the flows coming in. That again is inflationary, and deficit financing that takes cut itself. So all these are inflationary soundbites. So I think that's why the Fed is holding on. And they don't want to stroke the economy as of now. I think that probably by the end of the year, you'll see some positive news coming by.
Okay. Are you finally looking at IT? Because the number seems to be indicating that the green shoots are there.
So I won't say the green shoots are there. Okay, so basically, I think let's start with the first guy who reported TCS, right? The good part about the numbers was that the trough is over. I think the bottom one saw probably, and going forward, things look okayish. I mean, they're not. So basically, a steady growth rate is what we're looking at. And frankly, I mean, apart from TCS, who really added to his work pool, this is the indicator we were looking for because I mean that happened after 7 odd quarters of either cuts or remaining flat as such. I think that is what was the exciting part about the whole result, that they're looking forward to a growth number coming through as such. And frankly, I mean, we're still awaiting some kind of numbers, which will not numbers, rather sound bites, which will make us stand up and say, okay, this is the sector we want to overweight today. I don't think that's happening as of now.
Dinshaw, curious to know, what is it that you're making of this new SEBI consultation paper on F&O trading, and how that's going to impact the likes of your, angel ones, etc. Besides, of course, overall market trading volumes.
Yeah, so I think obviously, I mean, SEBI is concerned about the speculation which is happening in the F&O market. In fact, I came across one data point which itself was a really stark reality of what's happening out here. 85% of F&O volumes in the world are accounted by India. I mean, that was like a shocker, and US was some 12 or 13% of that. So it's obvious that there's a lot of speculation happening in that segment of the market. Obviously, the regulator is fairly concerned about it. And the fact is that whatever they're bringing on the table today, I think they're trying to make sure that it's only the real enthusiastic guys will come in, and not the one-off retail guys who want to just participate and lose money. I mean, the data that SEBI shared in that consultation paper was also fairly obvious that bulk of the traders are losing money there. But I think the bigger thing is obviously the volumes will shrink to an extent, but not to that much an extent, because I believe the bulk of the participation is also on the institutional side as such in the F&O market. But obviously, I mean, there'll be some shrinkage as such, and I think one big the one of the big proposals was to standardize the contract within the exchanges. I think that is the one which takes away the arbitrage between between the exchanges. I think that is what is more basically towards cutting off the volumes, I suppose.
Okay, great to have you on the show, Dinshaw. Always good chatting with you.
Thank you.